Have you ever wondered how to turn your emergency fund into a powerful tool for legacy planning? In this video, I'm going to demystify the world of whole life insurance, showcasing its multifaceted benefits that go far beyond just the life insurance coverage. From providing a safety net during unforeseen challenges to serving as a strategic investment vehicle for real estate and business ventures, whole life insurance offers a unique blend of financial security and growth potential. So stick around as I explore how this financial cornerstone can adapt to your evolving needs and pave a way for a prosperous future. Get ready to take charge of your financial well-being and unlock the secrets of long-term financial success. Let's go. Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and today we are demystifying whole life insurance and talking about how you can take your emergency fund, which I believe is the financial foundation, and you can grow it into becoming a massive legacy creation, and you can basically utilize it to become a massive wealth creating tool. And so we're gonna talk about this in this video, but before we get into anything, what I wanna do is kind of start from a 101 level and talk about whole life insurance, just what it is. If you're not familiar, if it's your first time here and you find value in this, make sure you like and subscribe and hit the bell and all these things if you find value in this video. Now, whole life insurance. Let's talk about what whole life insurance is. Basically, most people think of life insurance as death insurance, right? That's you buy life insurance, and if you die, your beneficiaries get a death benefit, and therefore that's the insurance is on the life of the person who buys it or the person that is insured. Term insurance, which is you basically buy life insurance for a period of time, for a term of time. And whole life insurance, you have insurance for the entirety, for your whole life, for your entire life. But what really marks whole life insurance and sets it apart from other insurances is the fact that it has a cash value component that comes along with it. This cash value that's inside of the whole life insurance policy can be leveraged in a lot of different ways that I'm going to cover throughout this video. But there are other elements of whole life insurance that come into play as well that we're going to touch on in this video that I think when you learn them, you're going to realize the powerful nature of this tool. But like everything else, it's just a financial product. Whole life insurance is not the end all be all. It's not going to solve every problem like a lot of influencers online are going to try to have you believe. I would caution you away from products like Index Universal Life that take a lot of the history and success of whole life insurance and kind of bastardize them and make it seem like it's something that they're not. But the goal and my aim and objective of this video is that you will leave this video with a much more clear understanding of whole life insurance and how you could potentially utilize it in your life. All right, so before I get into anything else, I want to talk about some of the misconceptions and the concerns that people have. Now, a lot of times when people think about whole life insurance and they compare it to term insurance, they're just looking at it like we talked about before in the death benefit. And they say, well, if term insurance costs $1,000 a year and whole life insurance costs $12,000 a year, why would I ever pay $12,000 a year for the same amount of coverage? Well, it's because, like I said, there's other components and elements to the policy like cash value and living benefits and other things that are not taken into consideration in the term insurance. And so we have to look at what are the values, what are the benefits of the cash value inside of whole life insurance. While some people think it might be just too expensive or maybe you don't have a need for it because you don't have any dependents, I'm going to show you why I think that even if you don't feel like you need it, you're probably going to say that you want it. So what I'm going to do is I'm going to go to my board here and I'm going to share my screen, and we are just going to go right to it. And I'm going to use this as a teaching opportunity. So remember, we're going to use an assumption that term insurance would be $1,000 per year for the comparable coverage for term insurance, okay? So that's what we're gonna look at here. Now, what I wanna show here is I've got these illustrations up showing a 25-year-old, a 35-year-old, a 45-year-old, and 55-year-old, and a 65-year-old. So I'm gonna just kind of go over to here, and I'm gonna focus on the 45-year-old because that's kind of the midpoint, and I don't wanna go through each illustration differently. All the principles remain the same. You can, when you're younger, you're going to get more death benefit because you're cheaper, because your insurability is better. You can see you get $242,000 of death benefit versus $187,000 of death benefit when you are 45 years old. and every premium I focused on is this $12,000 of annual premium, okay? So it's just important to understand. Now, somebody would say, if I could go get a term policy for, let's just call it $200,000 of death benefit for $1,000 per year, why would I ever pay this $12,000? Why would I ever pay this $12,000 premium, right? For a comparable coverage in that situation, right? Well, the answer is it's not really a $12,000 a year premium because we have this cash value component right here. When you look at the net cash value here, a couple things that you need to understand. The non-guaranteed assumptions, because a lot of people look at the guarantees and they look at the non-guaranteed assumptions. Now, whole life insurance, you have to think about from a couple of perspectives. The non-guaranteed assumptions right now, while they're not guaranteed, they're as close to guaranteed as you could ever find as in anything in the financial space, which once again, with IULs, the non-guaranteed assumptions are not even close to the same. Non-guaranteed assumptions assume two things. One, that the dividend is paid, which every company we work with has paid a dividend every single year for at least 120 straight years. And then the other one is that it's 100% of current dividend scale, okay? So 100% current dividend is the assumption. Right now, that's 5.2% with this example that I'm showing. It's the lowest in 80 years. So when we look at these numbers, we can think and look at them objectively with confidence, right? Now, full transparency, back in the 80s, that wasn't the case. When dividend rates were much higher and dividend rates were trending down, I could look at this 5.2% number right now today and say, you know what, I really think with a high level of confidence that the dividend rate is going to be higher. And so therefore, I think these numbers are actually going to improve based on what I'm actually seeing. The illustration is not going to be an exact match for what you have. What's important is that you understand the moving pieces and the parts and the functionality and how these things actually provide the results that you're after. I'm a big believer of running all of your decisions through a filter of what's the upside, what's the downside, and can I live with the downside, right? Like that's an important part. So now when we look at this, when we think about the fact that, okay, what are the misconceptions? Well, first of all, it's not just the death benefit here. We have this cash value component. Now, one of the things I want to draw your attention to is right here, looking at it at year 7. Okay, at year 7, you see you have $85,000 of net cash value. You've got a total of $84,000 in premium. If I were to pay $1,000 a year in term right here, all the way through year 7, I would have paid $7,000, okay? Right now, with this, I paid $84,000 and I have $85,000 of cash value. So I'm actually have more cash value than I had. Furthermore, because of the fact that we're utilizing paid up additions, what's great is that you can see this death benefit continues to grow, right? So while we started with $200,000 of death benefit, which was in the term policy, we still have the $200K. That's all we have. It's going to be a level death benefit. But in the life insurance, with the whole life insurance, as the cash value grows because we're using paid up additions, so there too does the death benefit. The death benefit is up to $311,000, which is a really, really powerful thing because when we say paid up additions, what that means is paid up additional permanent insurance. That is what it means. And so the cool part here is when we talk about the benefits of and the long-term value of whole life insurance is the fact that you have access to this capital, right? This cash value column is access to capital for collateralization, kind of like what you would do with a home equity loan in tapping into the equity in your house. You can tap into the equity in your whole life policy and leverage loans against it, never interrupting the growth of the column here. And the cool part about that is right now, loan rates are 5.5%, and the loan rates are capped at 8%, meaning it provides you with an asset that helps you control the cost of capital. Imagine you are at year 10 here, you've put 120 grand into the policy, you got 132,000 net cash value. Well, what happened if you needed $100,000 to go buy a real estate property, right? So imagine if you needed to go buy a real estate property, you needed $100,000, you could go borrow this at 5.5% on a guaranteed basis from your policy right now. Now that could go up or down. That could go up or down based on the Moody's Bond Index. However, what's important to understand is that it's capped at 8%. Now, if you look at secondary mortgages, investment mortgages, anything like that, you know that 8% is actually kind of where people are borrowing right now, 7 to 7.5%, 8% in that range, depending on your credit and depending on what you have going on. So the fact that you have access to this money, a lot of people are like, why would I borrow my own money? Well, you're not paying to borrow your own money. You're paying to borrow the insurance company's money. They're guaranteeing that they're going to give it to you, and they're using this as collateral. That's what you're doing. This is just a bond alternative type investment you can leverage as collateral, kind of like you would use the equity in your home as collateral to go do it. And now you're in a situation where you have access to cheap capital because they know it's secured by one of the most stable assets that you could ever have. That is the value of having that asset right there. So one of the other things that I think is really important to understand too is that when people are investing, one of the greatest lies that we're taught is the younger you are, the more risk you can take. And I'm here to tell you, the younger you are, the less risk you have to take, the less risk you should take. What you need to be focusing on is financial structure, setting your life up for financial success. This is why we talk about building an emergency fund first and then building on top of that, for your financial success. And so I just don't believe that you can have financial success without having a good financial foundation. Now, the one thing that I can say to this is that when you look around right now, our world is so jacked up when it comes to people's financial stability and their financial security and their financial structure. Time Magazine did a study and did a poll, and they found that out of individuals that make $100,000 a year or more, 51% of them are still living paycheck to paycheck. That means they don't even have an extra paycheck's worth of savings. That is a disgusting statistic considering we're supposed to be living in the most prosperous world in the history of, prosperous country in the history of the world. And when you look at it like that, and you really look at it through that lens, you start to realize how the financial system is really not set up for us to succeed, but we have to take control to do it on our own. I always say that it's important to have your financial foundation in place. And so the question is, if you have to have your foundation in place and you believe that having a strong financial foundation is important, where are you going to hold your foundational capital, right? I think it's important to understand that a properly designed whole life insurance policy is going to be the most powerful foundational asset that you could possibly have. But before you do that, I think it's important that you actually believe in the importance and you really wrap your head around and the concept of needing it and why you need this foundational asset. And the reality is a foundational asset is there to protect you from market cycles. But here's the deal. You could utilize a lot of assets as your financial foundation, right? You could utilize savings accounts, you could do all these things. So why whole life insurance as the bedrock to your financial life? Well, because I believe that whole life insurance is a self-completing plan. It's the only financial asset that you can put in that will give you money market-like liquidity, bond-like returns, and municipal bond-like tax treatment. And if something tragic happens to you, it's going to self-complete. You can go save your money in other accounts, and at the end of the day, if something bad happens to you, it's not completing your goals. I believe we were put here for a reason to accomplish something significant, and if you lean on a savings account to be able to have your emergency fund in, it's leaving you completely exposed from a generational perspective. So before I go any further, what I want to do is I want to show you what I mean by this. I want to show you how you can utilize whole life insurance as a savings alternative, how you can utilize it for real estate investing, and then how you can utilize it for potential business venture opportunities as we go. And what I'm going to do is I'm going to hop back to the vibe board here, and I'm going to show you the same examples talking about kind of life scenarios that people are inevitable to go through. So let's go back here. Let's go back in time. And remember, this can be applicable to anybody, no matter where you are, no matter where you're starting. I'm going to focus on a 35-year-old because I think this is where people start having families a lot of time in this day and age, and where maybe you're starting to kind of prioritize your financial well-being more for the first time in your life, and you're really starting to think about what your financial future could look like. So once again, what I'm doing is showing just $1,000 a month or $12,000 a year. You can see it picks up $251,000. Now, why did I do this? Well, I'm focusing on these numbers because of the fact that we're trying to build this net cash value. It's first and foremost. And what I want to do is I want to show kind of a life cycle. Let's say this person started, and once again, you can go back to 30, you can go 25, it doesn't really matter. But let's say you're starting your family. You have your kid for the first time. And now you got to start thinking about, like, all right, I've got college planning, I got retirement, I have, all these goals that I want to have. And, by putting money into my 401k, it's not going to get me where I want to be. I need to have an emergency fund. How much do I need to have in my emergency fund? Well, in this scenario, I'm doing $12,000 a year. I'm assuming that this person's making about $60,000 per year income, right? So if that's the case, well, how much do I need to have an emergency fund, right? So I would say in an emergency fund, I believe you need to have at least 1 year. A lot of people would say 6 months. Whatever it is to you, I'm not here to tell you what's right or wrong. I'm here to, encourage you to think critically about what your goals and objectives are. And so, if you think that 6 months of 60,000 is your number, well, then you need 30,000. Well, good news. If you save 12,000 a month, what's going to happen is by year 3, you're going to have 30,000. If you need to get to 60,000, it's going to be more like year 5, right? And once you have your emergency fund built, by the time you're 40 years old, you're going to have the ability to build an opportunity fund. Now this money is going to keep growing, okay? Now by the time what happens is that, like, you get to year 10, you've got 133,000. If you only need 30,000 in an emergency fund, now you got 100 grand to mess with. This money can be utilized for real estate investing, right? So you could tap into this for real estate investing, and now you're able to borrow against it and have access to cheap money to go buy real estate property. And so let's just say for, in one example, let's just get rid of that. Let's just say that you, in this $133,000, you wanted to borrow $100,000 for a real estate property. You wanted to buy a $400,000 property. Down payment is $100,000, and what happens with the total value, TV, is $400K, so you had to put a 25% down payment. And so now you get this at 5.5%, and now you get this at 7.5% in today's market rates, right? So when we look at this, look at the value of having your money here. Now what you do is you have this $400,000 asset. Let's say you pick up a mortgage of, let's say, $1,800, right? All in all, and you can pay this back accordingly. And let's say you pick up another $500 a month there, so $2,300, depending on what you have going on, and then you rent it for $2,700 or $2,600, whatever the number is. It doesn't matter. You just got to run these numbers. It's going to be different for everybody, but you're now able to positively pay back this cash flow, and you literally could take the payment of $500 to go into there, and I would even take the additional whatever above and beyond that number and pay it back in here and accelerate paying back, because what happens is this is what I call your collateral capacity. This 133,000 is your collateral capacity. So if you do a $100,000 loan down here, you're going to reduce this collateral capacity by 100 grand. So you're going to have 33,273 plus whatever interest expense at the end of the year. So you always want to use the cash flow from this transaction to do this. Now the good news is you pay back this loan. If you pay $800 a month, let's say you pay $12,000 back a year, you're going to say 100,000 times 5.5% is 5,500. But then you pay 12,000, you're gonna be paying down the principal or the principal on that as well. So the next year you're not going to owe 100,000. Your collateral capacity is going to keep growing because this number is going to keep growing no matter what. That's the power. You're never interrupting the growth of this capital, but your loan expense is going to be shrinking on a simple interest basis because you're paying it down like I just showed you. And so what happens is now you have this real estate venture. The next year, even though you took 100,000 and you paid it down, it's going to be all 100,000 is still earning dividends. And the next year you're going to have 150,000, right? Minus 95. So you could see that you still owe from the other loan, and you can see that you're in way better shape at this point in time. And if you continue this process, what you'll see is at the end, you're going to have your real estate free and clear. And if you just keep compounding the cash flow and popping it in every single year, within a couple of years, you're going to be able to buy more houses. You're going to be able to have more cash flow. You're going to increase your collateral capacity. You're going to be able to operate at a bigger level, buy more houses. And I'll tell you what, it beats a 401k all day long, because if you get to the end here, because you could see at 68 years old, imagine that you went through this and you were able to utilize this money in this column, and you were able to buy, say, 8 houses during this time frame. And at the end, you were able to have $661,000 and buy the 8 houses leveraging that asset. Would it be worth it for you to give up a little liquidity on the front end to be able to build this system that also provided $923,000 of death benefit? I don't know about you, but to me, the answer is a resounding yes. It's the biggest no-brainer in the world. And here's the thing. A lot of people get worried about the flexibility in these things, right? They go, well, what happens? It can't be an emergency fund if it's not flexible. I don't disagree with that. The beautiful part is that whole life can be astonishingly flexible. When we look at whole life insurance from a flexibility perspective, it completely changes the game. Now, in all defense of the people that love to hate on whole life insurance, here's the deal. We're going to go to this 35-year-old. You can see the 35-year-old right here. We're going to go to this 35-year-old and we're going to look at this. And what I want you to do is see this, is that this is how flexible it can be. You can see here the first year premium, and this is the scheduled premium, is $12,000, but the minimum required premium is only $2,758. So it's like a $10,000 gap. So if times get tough, you can reduce your premium to here. Furthermore, you can utilize what's called a premium offset to pay this, and you can utilize dividends to pay it. You can utilize a lot of different things if the policy has the cash value in the policy to maintain it, right? And so it makes it really flexible. You've got a big gap. That's why you want to always make sure that you design these policies to meet your goals and objectives, to be flexible. And you can see that out of this, you have a term rider is the bulk of it, and the whole life insurance is actually a small amount. That's how we're getting in as much cash value. That's how we're making them as liquid, because now we have the paid up additions rider is accounting for the majority of the policy. That's one of the ways that we're able to do this. Now, depending on your age, depending on your objectives, depending on your insurance wants and desires, obviously my take on this is that, $225,000 out of the gate is not enough. It's just not enough. So you're gonna have to supplement this with an additional term policy, right? You're gonna wanna add that on top of this. And I would say go get a convertible term and buy a convertible term high enough to buy your net worth. And what I would say is typically it's about 20x income, what the insurance company will give you. And my rule of thumb is if they're going to give it to you, get all of it. I just got another $2 million of term insurance the other day before coming down here, because at the end of the day, if the insurance company is willing to give it to me, I'm going to take all they'll give me. That's kind of my rule of thumb for life, right? Because that gives me the ability to buy my net worth that I want to leave for a legacy. And then I'm going to focus on building my cash flow. As I have my net worth secured, I'm going to work on building my cash flow through real estate, through other businesses and stuff like that. I can leverage the cash value in the policy as a hard money lending vehicle, as a private money lending vehicle, and it's a really, really powerful thing. Here's the other thing about whole life insurance. It is what we call a volatility buffer. Now, I mentioned earlier that it's a bond alternative. It's a bond alternative with amazing stability. Most people think of bonds as like financial foundation. Once again, for their retirement planning. If you know anything about retirement planning, you're very familiar with the 60-40 portfolio idea, where 40% of your portfolio in retirement should be in bonds to help protect you. Well, that didn't work so well in over the past 3-4 years, when bonds and equities lost money bad on the same years. And so the whole 60-40 portfolio is dead. Whole life insurance still held the line, so to speak, and is getting the results for people as a volatility buffer. And when you look at bonds in any 10-year window over the last 80 years, then bonds have beat whole life insurance over every 10-year period. However, over every 30-year period, bonds have lost to whole life insurance. So if we're thinking long enough term, then we know whole life insurance as a bond alternative is always going to win. And so that's a big thing. It's going to stabilize, it's going to protect you in your personal finances, and it's going to be that volatility buffer and the bond alternative for you in retirement. Now, on top of that, in retirement and throughout the duration of the contract, it's also going to be a medical directive savior. And what do I mean by that? You have living benefits. If you become critically, chronically, or terminally ill, you are able to accelerate the death benefit for alternative medical treatments that your health insurance companies will not cover. I share the story about my father-in-law all the time, who had stage 4 pancreatic cancer. We were able to accelerate the death benefit of one of his life insurance policies to be able to help pay for his medical needs. And it was an absolute game changer. So those are the powerful components when you're alive. But at the end of the day, we are talking about life insurance, right? And so while I just showed you all the ways it can help you when you're alive, a lot of people think that term insurance is the way to go because you don't need life insurance. But I promise you, if you were to ask every 85-year-old, every 90-year-old, every 95-year-old who's lying on their deathbed and is facing their imminent mortality, and you were to ask them, hey, do you have life insurance? And they said no. And if you were to ask them if they wish they had life insurance, I bet you almost every one of them would say yes, they do. They wish they had it. So if you had a product that could be there with you throughout your life to help you solve all these different problems that you knew would be on a guaranteed basis, would be there on your deathbed at the end to pass on the most efficient tax-free legacy that you could possibly find in the financial world, is that something you'd be interested in? My encouragement to you is to dive deeper, to look deeper, to do your research, to understand this. This is just kind of an overview video to get you to think about things a little bit differently, a little bit more critically, to open your eyes to the potential and the possibilities that this asset can provide for you. So I would really encourage, go check out my playlists. If you're interested in learning about this for yourself, go set up a clarity call with one of the Life 180 coaches down below. You can just go down to the link in the description below and do that. But if you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. Till next time, have a blessed, inspirational day. We'll talk soon. See ya.